Jump in and ask questions if you don't understand something, or if you just want to share a point based on your experience. This is going to be a conversation. So feel free to, you don't have to save your questions to the end. All right. Well, some of you might know I'm a lawyer, and so gotta have a disclaimer. Um, and so the TLDR here is, and hopefully you can see the screen. Let me know if you can't see the screen. I will also be checking the chat. So if you wanted to ask a question in chat, I will check the chat periodically to make sure I am answering your questions. But if you can see the screen, which I hope you can, there is a disclaimer here. And I just want to be clear that even though we're an investment firm, we are not a financial advisor, a registered investment advisor. And even though I'm a lawyer, and for the purposes of this workshop, I'm not giving legal advice, I'm not giving financial advice, or actually investment advice. We are just going to be talking about like some of the things that I've seen and learned over the course of my over a decade experience in finance, as well as my experience in alternatives. So I'm going to pause and let you all read the disclaimer just so we're all on the same page. Okay. Um, Hopefully that was okay. Oh, I saw a chat. I want to make sure I am paying attention to the chats. Oh, cool. Of course, eat. It's lunchtime. Yes. All right. So the way that this session will be broken down, we'll spend like the first half talking about the framework, specifically what the Wealthy Do framework. We'll deep dive into it, break it down. But just know that it's more of a 50,000 foot strategic view. Um, so these are the strategies that the wealthy use. We're not going to spend a lot of time speaking about the tactics that they use, because they invest millions and millions of dollars to innovate in the space to find different ways to preserve their wealth. And so even though if I spent some time talking about tactics today, there's somebody coming up with a new innovation or a new tactic, and it'll make my conversation obsolete. So we're only going to be talking about, for them from a wealthy perspective, the strategies that they use. But then at the second half of our conversation will be spent on different tactics that you could use to start to incorporate this wealthy mindset framework into how you manage your wealth. Now, it's the list is not intended to be exhaustive, nor is it intended to be a roadmap. Do one, two, three, four, five in this sequential order. It's not like that. There'll be some things on the list that you're like, I'm not doing that. There are certainly things on the list that's like, I'm not doing that. That's not my not my ministry. I don't want to spend my time that way. But there are things I hope that will get you to start to jog the creative, or get the creative juices running on like, oh, I've been thinking about this way, perhaps I should think about it in a different way. And so that's the point of all the different tactics that we're going to discuss that you could be using in your day-to-day life. Okay. All right. So my wealth journey, just to let you all know like how we got here, or how I got here, and then you obviously are here with me. I always knew that there was some significance about money. Like, and even from a very young age, I never spent everything I got. I was always kind of squirreling it away. And my mother loves to tell the story. In '86, I was 8, and my brother at the time was 14. And he, on a Saturday morning, let some solicitors in the house, and he had to come and wake me up, his little sister, to go into my stash to give him money to give to them so they would leave the house. And so she loves to tell that as a story of like, oh, she's always been about her money. And then, fast forward to 2004, I was working as a young lawyer in Baltimore, and and even then I knew like, this salary is good, it's more than what my dad makes, but I think I should be doing something more. And so I decided to buy a house, and at the ripe age of 25, yeah, 25. And I knew that it wasn't my forever home. I knew that at some point I would rent it, and it did not completely go as planned, but I learned a ton. And um and I'm glad I did it. And it's funny, there's a partner at my firm was kind of like, I remember him saying to me like, did your parents help you buy the house? He was very like incredulous on how I got this house, which is like a story for a different day. But yes, and then in '09, I thought, okay, the way I've been doing going about life is all right, but I could probably do better. And so I think I need to go to business school. And I want to go to a business school where the wealthy people send their kids so I can learn from them and I can be in the space where they're money, frankly. And I very crassly announced this at lunch one day with someone who I did not know who was independently wealthy. He was my classmate, and luckily he didn't hold that against me, and we're friends to this day. But I did say it, and I can't believe I said that. But anyway, but this all came to a head for me in 2022, and it also is when I started Margins Capital. But I invested in a venture capital fund, and it just became clear to me that, oh wait, there is a difference on how I was right. My hypothesis was right. There is a difference on how the wealthy manage their money. And so it just made me start to go after it a little bit with a little bit more vigor, I guess. And so after doing some market research and hundreds of conversations and countless hours spending reading books and articles, it led to the culmination of this very simple framework, which is the wealthy have a specific mindset that they use in how they make money and how they manage money and how they move money. And we're going to dig into all three of those. Make sure I'm flying, and okay, no questions so far. All right. Now we're getting to the meat and potatoes. Okay. First things first, making money. Um, you know what? I'm gonna do my poll, and I need you not to cheat. I'm gonna go back so you won't cheat. I have a poll that I want to do to see if you all what you think here. Okay, take a minute. I want you all to answer the poll if you can. All right, I got two. Are there only two? Are there three of us? There's a third one on the call. I don't know if someone else wants to answer one last. I hold out for the last person. Take a guess. Any guess? Give a few more seconds here. Okay. All right. All right. Thank you all for bearing with me. I'm not going to share the results just yet. Give me just a second. I am going to move it here off screen. Okay. All right. So, how many of you all heard about um, an ownership mindset? Um, and you don't have to answer. You can answer if you want to. Well, I know when I first heard of it, and people throw that term around a lot, and I'm like, I don't know what this really means. Okay, ownership mindset, sure. All right, I see a chat here. Yes, love that. Okay, got it. The ownership mindset. I'm like, I don't really, but what does that mean? And what it means is they are like, my portfolio pays me. The things that I own pay me. They want to make money from dividends or distributions. And distributions are basically like if you own a company or own part of a company, they will sometimes just send you money. um, or and a easier way to think about it is like when you're retired and you start to get money from your 401k, they will give you a distribute. You would take a distribution from your 401k in retirement. It happens similarly in for companies or other assets that you own. For instance, if you own a commercial real estate, if you invest in commercial real estate, they will make distributions to you every quarter, sometimes every month. And so they want to make money by from their distributions, from dividends, or by selling shares of whatever they own, whatever equitable stake they own. They do not want W 2s. So it should come as no surprise. And this is why they don't want W 2s. Let's stop here. The income tax rate. So if you're a very, very wealthy person, you're going to be taxed at the highest taxable rate versus if you get a capital gain from a dividend or a distribution, then you're only going to be charged 20% versus 37%, which is the highest taxable rate there is. All right, so I'm going to share results. Can you all see the poll results? Hopefully you can.
We can see it.
Oh, perfect. Okay. So, ha ha ha. What? So I love this. I love this poll, and I'm so happy you all answered this. And you were kind of close, but not quite. Somebody who answered the 1.6 million. But Jeff Bezos, our dear friend, owner and founder, well, majority owner. Well, I don't want to say majority owner, but very rich man who founded Amazon from 1998. So he founded Amazon in 94 and 98. From 1998 to 2021, when he retired as the CEO of Amazon, his annual salary was just shy of $82,000 a year. I'm going to stop sharing that. It was just shy of $82,000 a year because of the tax rate, right? He full stop. So let's think about let's talk about at the beginning, at the top of the year, he sold about $6 billion of his stock. And if it was treated as a bonus, a RSU even, no, not RSU, no, let's say a bonus or a salary, he would have paid $740 million on that. And this is a very simplified view. I did not go into do the whole marginal tax thing, but on average, he would have paid about $740 million. Instead, he paid $400 million because it was a capital gain and it was taxed as such, right? And that's a big difference. Like 300, like that's a lot of money. He gets to take home $5.6 billion. But okay, I know we're talking like crazy numbers and it's like, it's kind of hard to really internalize those. So let's just imagine that you were, you're at your dream job and you're making the salary that you said you wanted to make. Say it's like, I think it's 343,000, I think is the number where you get into the 37% tax bracket. So the next $100,000 on top of that, let's assume that's you, and you could either pay 37% or $37,000 or 20% of that $100,000 or $20,000, which is a big difference. When you rather take home $80,000 versus $63,000. So they do not want a W-2. They want to be paid from their assets. Okay. So that's first thing. How they manage their money. They believe in investing and then investing some more. They always want their money to be working for them. I talked about, I don't know if you all saw my Wealthy Wednesday from a couple of weeks ago, and I did the math on what happens if I just save versus investing. And inflation is just going to eat that savings so fast. Like it's just going to eat it up. So you have to invest because that's the only thing that's going to outpace inflation. And inflation is another guarantee of economics. It's of the world. I won't even say US. It's a guarantee of the world. right? So they're always looking for how do they invest? Where can I invest? And where we often think about investing as a tool for our retirement, billionaires, mm, there's a question, billionaires or high net worth individuals are often thinking about, and thank you for that, Ariel, are often thinking about how can I invest to build my wealth to have a better life, my day to day life. Like, it's not about what I'm gonna start living when I'm 60. It's like, I'm living now. How do I enhance my life now? So I like living at the beach. I like the beach, right? So how about I buy a home that's on the beach so that I can go to it whenever I want to? And it's an appreciating asset. Like, they're obviously buying homes that are going to appreciate in value. Um, and or I like Ariel, you would like this. I got this from your sister. I like going to Broadway shows. Like, so why don't I invest in Broadway shows? Because that's where I like to spend my time. And it's a part of me enriching my life, but also I'm investing at the same time. I like fine dining. Why don't I invest in this up and coming chef so that I can be in the space with Bobby Flair, yada, 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 right? So they're constantly thinking about how do I invest my money to enrich my life? Whereas people who are not billionaires are thinking about how to invest my money so that I can start working at some point. Um, and so they're always ensuring that their money is working for them. They are not selling and letting it and putting it in the savings account. They're selling, if they're selling their investment, excuse me, if they're selling an asset, it's because they're putting it into another asset. And they use something called a portfolio loan to do that. So for instance, a portfolio loan, think of it as it's basically a mortgage, but for your portfolio. So a mortgage, you don't own a house, you get a loan from a lender to buy a thing, to buy a house. The house is what is securing or what is guaranteeing, if you will, the loan. The same happens for a portfolio loan. So your assets, all the things that you own asset wise, a good example is look at our favorite South African investor and entrepreneur, Elon Musk. And yes, that is sarcasm, but Elon Musk used his Tesla stock, his portfolio of Tesla ownership, to fund the purchase of Twitter, right? Or now rebranded as X. So that's how the wealthy are leveraging their assets to buy additional assets or make additional investments without taking, their assets out, without stopping their assets from working for them. Does that make sense? I hope so. Ask me if questions. Okay. If you have more questions about that, let me know. Another thing they do is invest in, yes, it's like a HELOC, exactly, but against your, that's exactly right, Ariel. It's a HELOC, but against your investment portfolio, HELOC or a mortgage, exactly. They also invest in alternative investments, right? And so alternative investments are any asset that's not cash, a stock, or a bond. It's any asset that you buy in quote unquote the private markets, right? So you can't just open up a brokerage account and invest in the thing. It's a little bit more involved than that. And this statistic that I'm about to show you is what confirmed my hypothesis for why margins was absolutely necessary for people who are not billionaires. And I am going to make the assumption that y'all are not billionaires, because if you were, you probably wouldn't be on this call. Yes, exactly. And exactly, Akwase. That's exactly right. So I don't know if you all see that in the chat here. Portfolio loans, they're classified as debt, which again reduces their tax exposure because you don't tax income. Excuse me, you don't tax debt. A lot of them use portfolio loans to live, but a lot of them, I think, the vast majority of the wealthy are going to use portfolio loans to invest and do something to add to their wealth, right? And some of them might use a little bit to live and do things like that, but for the most part, it's always like, how can I continue to make my wealth grow? All right, so this is a statistic that I looked at, that I alluded to. Okay, let's see. All right, so
Mm,
just to walk you through this chart, this table. So this top row is a categorization that folks in finance use to bucket people based on their net worth. Net worth, in case you don't know, it's like all of the assets you own minus all of your liabilities or all of the debt, the credit card debt, the mortgage, the car loan, the student loans. You subtract that out, and what you have left is your net worth. And so the mass affluent folks have a net worth of anywhere between 100,000 and a million. High net worth, a million to 5 million. Very high net worth, 5 to 29 million. This is my favorite bucket here. Ultra high net worth, over 30 million dollars. And it's funny because if you're on social media, they if you're not paying attention, it would seem like everyone is in this bucket. But this bucket is less than 1% of folks in the US, right? So it's like it's 225,000 or so of people are in this bucket, including Jeff Bezos. And but they represent 30% of the money in the US, right? So like they're a big deal, and they're quite powerful. But what's important is how they invest their money. 4 out of 5 of these people have half of their wealth in alternative investments. I want to pause for effect because that blew my mind, right? Like half of their money are in alts, where the mass affluent, even though there are some people here that are in alternatives, but the vast majority of at least marginalized folks, women, people of color, are not investing in alternatives. But the super high net worth people are, and that is why the wealth gap is continuing to spread at the clip that it is continuing to spread. And so that's why I'm like, no, we need to change that. And then I don't even have, obviously, the number for women and people of color who are investing in alternatives is negligible. I can't find any statistics about it. Um, but just to let you know, I mean, I think the number of um, Black billionaires are, I think it's 7 in the US. There's 7 out of that, out of quite a few. I think it's a list of 400, and they represent 7 of them. All right, so we talked about how the money how they manage their money. They're always investing. I'm sorry, I get very excited and a little disheartened by the statistic. So moving on, the last mindset bucket is how they move their money. And in particular, I'm talking about how they move their money from generation to generation. And so it's not about how much you make, it's about how much you keep. And so let's talk about the cost of not having systems in place to protect and maintain and keep your wealth. So probate fees, if you don't have a will, every state is gonna, not every state, but the state you live in, the court system is going to charge you 3 to 8% of your estate value to manage and distribute and dissolve your estate after you die. This number obviously goes away if you have a will, but if you don't, you're going to give part of your estate to to the courthouse. Also, there's an estate tax. If just to, so this 12.9 million if you're single, or 25.9 million if you're married, is exempt. So every $1 million over that, the government is going to take 40% of it, right? So every million, you get to keep, your family gets to keep 600,000. The government's going to take 400,000. And this number, this exemption amount, these exemption amounts is from our dear friend Donald Trump, who did it to protect. He raised this number significantly to protect his homies. The number when, let me see, I have it. When President Obama was in office, it was $5.4 million for an individual and 10.9 million for married couples. So he basically doubled the exemption amount for his rich friends. And this is going to expire, and if it might be a problem for people, it might go away. And if Biden wins again, he probably won't keep these numbers as high. I don't know if we all have that problem yet, if we're concerned about this, if we have estates of this size, but it is something to be mindful of. They also use life insurance payouts. They may not be taxed. So if you purchase life insurance with after-tax dollars, then the life insurance benefit will not be taxed. And this is an important tool that the ultra wealthy, so people who have a wealth of well over this amount here, they're going to leverage life insurance. They're going to over insure themselves so that their beneficiaries will get the benefit without having to pay that terrible 40% estate tax. But again, these are things that they're often thinking about and they're planning for, just so they can preserve their wealth. And then lastly, they might use trusts, and there are a ton of different types of trusts that they can use to make sure that they're preserving and avoiding the majority of taxes. So I want to talk through what happened to our dear beloved Aretha Franklin, because just because you have a lot of money, that doesn't necessarily mean you have this wealthy mindset, right? So Aretha Franklin died in 2018, I believe, and she was sick, right? So she theoretically had an opportunity to, create a will and get her affairs in order, but she kind of didn't. But they did find a will in the cushions of a couch. Anyway, so when she died, the value of her estate was $18 million. Probate fees, I'm gonna jump around here. Probate fees in the state of Michigan, she paid 6%. So that was, the courthouse took $1.1 million of her money because of where the exemption was. She ended up paying 4.96 million dollars of her estate in the estate tax.
Oops, sorry.
No, it's fine. And then, unfortunately, she had some previous IRS tax debt totaling 7
Oh,
point.
girl, shit.
I know. And so her family, her sons, even though they were fighting and all the things or whatever, they only ended up with less than a quarter of her wealth. And that is just the saddest story ever. It's so sad. It really is. And yeah, I don't even have anything else to say. It's sad. It's crazy. I don't want that to happen to any of us. It's, yeah, sorry. Does someone have something to say or no? Yes. Anyway, so okay, so let's talk about it ending up this session. I want to make sure I have enough time to talk about the what we could be doing as while we're on our road to billions. Yes, it is crazy, Ariel, and it is It happens to so many of us, and I would it would the money I worked so hard for, I would turn over in my grave if A, my daughter messed it over, and B, if only like even if I had $100,000, if only 25,000 went to my daughter, I would be so annoyed by that. It would be crazy. Anyway, so let's talk about Steph versus Jeff. I'm Steph and Jeff. And just to talk about the difference in the mindsets and what I've had to overcome and what he has um had to overcome too. Let's talk about that. So we talk about a mindset shift, right? He has clearly his family, the way they are set up, they come from an ownership mindset. I know that because his parents, well, his granddad owned like a 25,000 acre ranch in Texas, and his mother gave him $250,000 as seed money to start Amazon, right? Whereas I grew up with a preservation mindset, and it was just like, let's keep what we got. We're doing all right. Let's keep what we got. And and Jeff was clearly about growth. From a making money perspective, my dad was like, my parents were like, get yourself a good job. Whereas, you look at Jeff and he paid himself $82,000 because he recognized that his portfolio is where his true wealth and his payments and earnings will come from. I was taught to save, save, save. And Jeff was taught to invest, 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 and mitigate taxes, which he has obviously shown throughout his career. Luckily, my parents did have a will. My dad had a will, and clearly, Jeff's family and his lineage did as well. Hence the fact that his mother was able to write him a $250,000 check, and his brother and sister in their 20s were able to write $10,000 checks to invest in Amazon. And of course, they're billionaires today. So let me see. I want to make sure any questions. All right. I feel like I sped through that, but first half, like I said, we would talk about what the wealthy do. But I really want to spend a significant amount of time to talk about what are some things that we can do as we are trying to, increase our wealth, grow our wealth. And everyone is not necessarily trying to be an entrepreneur. You know what I mean? But there are things and different mindset shifts that I think we can, we can do to help preserve and build the wealth that we have faster, right? So first, let's talk about make money. As a reminder, making money is about earning money from investments rather than earning more money from your investments rather than a W-2. And so some of the things that we can do are we can invest in equities that pay a dividend, stocks, right, that pay a dividend, and be really thoughtful about that. We can also start to work and consider working for private companies. So there's an amazing stat: 87% of companies who have a $100 million of revenue or more are private. Like if you're paying attention to social media and the news, the only thing that people are talking about, you would think that stocks rule the world, and they're very important. Like, let me be clear, they're very important, but they're not the only business in town. They're not the only game in town. So if you start working for private companies, which there are a lot of them, you can negotiate equity, right? And that way, that's a way for you to build your wealth. You can also start to negotiate flexible compensation. I didn't mention that that Jeff Bezos, even though he made $82,000 salary, he got his total compensation was more like $1.6 million. So someone had that right, because they pay for his security because he's a billionaire, and people might want to think they're in a movie and kidnap a billionaire and yada yada yada. So they pay for his security. And so there are things that you could potentially negotiate to make your compensation flexible so that you can augment your life without necessarily having earning more money from a W-2, so you're paying taxes on it. For instance, you can negotiate like, hey, why don't you pay some of these student loans for me? Or one thing that I'm considering is with my company, I am currently paying my health insurance out of pocket through the Obamacare, hey, uh, the marketplace, but perhaps it makes sense for, to reduce my salary, pay fewer taxes, and then let my company pay for my insurance. I'm still working the math out on that, but it's about being creative and not just accepting the status quo that our parents, God love them, and that the world teaches us, or displays to us. Another thing you could do is you can expand your investment portfolio, specifically your retirement portfolio, by investing in alternatives via old 401ks. So if you worked at a place and you had a 401k there and you haven't moved it over and you haven't done anything to it, you can move it to a self-directed IRA and then direct it to invest in something other than, if you're at Fidelity, like some of the stocks that are available and some of the target date funds that are only focused on stocks, because we are over indexed in investing in public equities. And I think we should all be trying to figure out a way how to invest in some alternatives. Another, this HELOC one, I need you to be careful because of the current macro environment we're in terms of like the interest rates are super, super high. This really made sense when capital was cheaper, and interest rates were really, really low a couple of years ago. So if you decide to leverage your HELOC, make sure that the numbers work. I do think there are certain investments that you can make where the math will work, but I just want you to make sure and be thoughtful about what the math is before you start taking out a HELOC on your home. The last two bullets, I I have them in here, but I want to be cautious, and I want to give a caveat because personally, when I was working in corporate America and I was exhausted and I was coming home, and then like I would get on social media and someone would say, "Oh, you just don't want it enough." Like you're watching Netflix when it's like, I am tired. I have a baby. Like I don't want a side hustle. But if that is your ministry, and if owning real estate, individual real estate, like building up your portfolio individually, like that is your ministry, it's a wonderful way for you to make additional money. And and it's a way for you to make money from something you own rather than a W-2. And you can pay yourself in distributions. You can be thoughtful about how you pay yourself so that you don't have the tax burden that you have by working for a company. All right, I guess we're good for time. We are. Okay. In the managed money bucket, remember that is investing as much as possible, reducing your taxable income as much as possible. So again, you just want to invest as much as you can. You want to add alts if you can to your portfolio. I shouldn't say recommend, but I'm gonna say it, 5 to 15%. But obviously, as make that decision based on your risk profile, your financial goals, and you do that math for yourself. But you just want to invest. You want your money working for you as much as possible. Um, and that is just going to expand your life today and your retirement life whenever you decide to retire, and potentially allow you to retire faster. You also want to take advantage if you work for a company that allows you to have access to a 401k or a health savings account or dependent care flexible spending account, as well as a flexible spending account. You want to take advantage of those, because what happens is when you move money there, you're reducing your taxable income, right? And so that means you're going to pay less taxes, right? If I make 100,000, I'm going to pay more taxes than if I made 60,000. It's just math. But again, you need to be thoughtful, because especially with the flexible spending account, like you will lose it if you don't figure out a way to use it to enrich your life. The beauty about the health savings account is you can invest it. So the difference between a health savings account and the flexible spending account. In the flexible spending account, you have to spend that money within the year that you took it out, right? So if I took it out starting, let's say November, and I took it out for the year 2024, I have to spend it in 2024 and return my receipts to my the plan manager and all the things within a close time frame of 2024. I think it's the first quarter of 2025. Versus a health savings account, you don't have the limitation of um, having to recoup and spend all that money within a year. It's either 3 years or 5 years. Do the math, do the research on that. And so you can absolutely take the money, invest that money, and that money is yours. And whatever you and all the returns you get is yours. You just have to keep track of your health expenditures, and say in year 2 or year 3, you can go back from, oh, in 2027 you can give receipts for something, for money that you took out and set aside in 2024. Does that make sense? Okay. Um, Another thing you could do is, and this is a beautiful mindset shift. I love this because it a lot of us, when the market is down, the stock market is down, we start to freak out, right? And our instinct is to sell, like sell it because I want to mitigate any losses that I am potentially exposed to. Well, one way you can flip how you're thinking is, sure, you can sell your stocks at a loss and use that to write off on your taxes, right? So if you take a haircut in the stock market, you use that to write off your taxes in 30 days. It generally is going to take more than 30 days for the market to correct itself. You repurchase, you get back in the game, you repurchase that stock. And so you just got a tax write off. And I did not do this when I had my crypto, and I took a humongous haircut in the crypto market in the last crypto winter. But this is something that you could start to do. And so it's, the mindset shift is, don't get freaked out. You're like, oh, okay, how could I use this to make my life better? And that's an example of one way to do that. Let me see, I have a quote here. Yes, you have to wait 30 days for stocks, but for crypto, you don't, because it's not a security. Yes. Again, I didn't do it. I learned later, but be better than me. And maybe next time I will. So, and the last two things, the last two buckets, the backdoor Roth. So a traditional IRA is, if you get a traditional IRA, you have to pay taxes on your distributions when you start to get distributions after you're 59 and a half, I think the date is. Versus a Roth IRA, you don't have to pay taxes on it. You can put after-tax dollars in, but you don't have to pay taxes on those distributions as they come to you after you're 59 and a half. So one way to do that is, if you're making over the income limit, which is, I think, around $161,000, you can open up a traditional IRA and immediately transfer it to a Roth. And that way, that's why they call it backdoor, and it becomes a Roth, and then you get your tax-free distributions when you retire. So you were not excluded from Roth depending on your income. And then the mega backdoor 401k Roth, this is something I learned by putting this together. It is, let me give you an example. Okay, so a lot of you all are probably aware that your 401k, there's a max contribution limit, individual contribution limit of around 20K. I think it's up to 23K is what I have this year. And then the company can match you for how much they want. And let's just assume for this example that the company matches you dollar for dollar. Well, there's actually a total max 401k limit of $69,000 that you can put in your 401k. I didn't know that. I don't know if you do that. And so that means that if in this example, you can put an additional $23,000 in your 401k to save for retirement. Now, it is going to be post, well, actually, it may not be post-tax. It all depends on whether or not your employer offers it and whether or not your employer financial like 401k plan offers it. But this is also a potential thing for you to investigate to see if it makes sense for you. Does that make sense? Okay. All right. And then the last bucket here. Okay, we're doing okay. Last bucket here is you just want to avoid probate fees and mitigate the taxes that you're going to pay on your estate. You basically, I hate to say this, the queen of R&B or soul in R&B. You just don't want to be like her. Like, don't be like her. So you want to have a will to avoid probate fees. I know it can be morbid to think about death. Actually, I find it to be empowering to control all my money and how I want it to be and how I want it to be spent and used, even in death. But mindset shift. You want to use term life insurance, and you want to use term life insurance because you can be you investing the difference. So obviously getting a whole life policy is going to be more expensive than term, right? So that difference in the premium, you will be better off investing it on your own than investing it with a whole life insurer. They try to teach you, they try to like, if you're not a billionaire yet, if your estate isn't over the 25.9 million if you married or 12.9 million if you're single, then you don't need to over invest in life insurance to avoid estate taxes. Like, you just don't. So you just be you just are you want to be smart about how you leverage life insurance, and you want to talk to a professional, block out the noise, because it's a lot of foolishness on Instagram. It's a lot of foolishness, and don't get wrapped into it. And then consider trusts to figure out a way, if it makes sense for you, and how to preserve your wealth and potentially mitigate tax liability. It makes sense to spend the $3,000 to $5,000 on a lawyer to help you get your estate plan set up. It is a worthy investment, especially when you think about how much money you're going to make over the life. We're still young, God willing, we will still be alive for 30, 40 more years. And so that $3,000 to $5,000 is a drop in the bucket. It really is. All right, I see a chat. Okay, thank you, Miriam. All right, so last thing, I just want to again highlight, this is a mindset shift. It is a practiced behavior though, right? So don't look at this and be like, oh man, I'm doing it wrong. No, you might not have known some of these things, some of the things you might have known. But I will say, continue to talk to people, because I learn a lot by talking to people, and not sharing and not discussing money. I really want to normalize us discussing wealth and money, because that's how you learn and that's how you do better. From a mindset perspective, start just by noticing where your thinking is a little different, and then figure out whether or not that misalignment warrants you to change or it doesn't. It might not, right? Like, you might be a person that, like, I don't care. I want to sleep at night. I don't need alternatives. I don't need the risk. I don't need the stress. I'm like my ETFs and I'm good. And that's okay, right? So you figure out what works best for you. But some of these things, I'm sure, I'm hoping that they added value, and you're like, oh yeah, I can, this might help me think about things a little differently. And then again, we talked about this, but ownership and investing is the only way to move between the wealth bands. It is not saving. That is not going to be enough. And then lastly, I just want to highlight a couple of upcoming things that are happening for margins. Also workshops that we're working on, just so you know, and you can engage with our social media to figure out if any of this makes sense for you. We are launching our first funds. And it's basically, the point is, we just believe that women and people of color should have access to alternative investments without having to spend $200,000 to invest in a fund that's based on a particular asset class. And so our fund is taking it's very similar to your 401k, and it's taking a portfolio approach where we will invest in different asset classes and alts. And you would just have to pay $10,000 to get access to that. We are going to be on Below Deck, which is crazy to say out loud, but we are. And so our episodes air on May 20th and May 27th. We are the finale. Hopefully, we don't get dogged out by the crew Below Deck. Girl, I have no idea, but it should be fun. It was fun. It was a fun experience, and we're going to share a lot more behind the scenes. Not even behind the scenes, but it's more just like our thought process and why we did it and what we learned and all of that. There's going to be a lot more of that information coming forth. And then I think I'm going to offer this What the Wealthy Do workshop a lot, and it's free, but it's just because I believe that the more we know, the better we are as a people, and that's the hill I'm going to die on. We are working on putting together a maximizing your corporate benefits workshop, very similar to how I talked about, like, how do you do the math on a health savings account? How do you do the math on all of those other accounts? And it'll be a lot cheaper than our longer, like, demystifying alternative investments course will be kind of a longer play and a longer multi-week course. But that is all. I thank you all so much for giving me an hour of your time. I'm going to send you out I'm going to send you the survey. So if you could just respond and give me your thoughts, tell me how to get better, tell me if it's a complete waste of your time, like all the things. And I'm just so grateful to have spent this time with you. Thank you.
Thanks, Stephanie. Appreciate it.
Oh my God.
Thank you, Stephanie.
So good. Thank you.
It's so good to see you, or not see you, but see you. Hey.
Yeah. It's been ages, right?
I know. Where are you again? Are you in Boston?
Yes, I'm currently in Boston.
Yes. Okay.
Yeah. I've been on the road for the last couple of years, but ended up in Boston like 3 years ago.
Do you like it? It's cold and racist.
Well, I haven't experienced it. So
Look,
I work
I should
with
stop
Berkeley,
recording.
so most days I go where I need to go. If I don't need to be there, I'm not
That's
there.
real. Get that bread.
But this was really fun. It confirmed a lot of the findings